Today we're going to be talking about the Wirecard Scandal in the context of ethics in financial accounting. In today's presentation we will cover the parties involved, the scandal, the ethical implications and the lessons we can learn from the scandal going forwards. The Wirecard Scandal involved a German payment processing firm, Wirecard, and its auditor, EY. To better understand how Wirecard's scandals led to $12 billion shareholder losses, over 1,000 job losses and a $1 billion lawsuit against EY, we must analyse 4 key accounting frauds: fictitious merchants, opaque acquisitions, fake escrow accounts and round tripping. Before we delve into Wirecard's accounting frauds, we must analyse payment processing transactions. When customers purchase goods and services from merchants, they must enter their credit card details. The merchants then forward customer credit card details to Wirecard, who would forward it to an issuing bank. Wirecard would collect the relevant cash from the issuing bank when due and send it to the merchant, collecting revenue from service commissions. So surely Wirecard's transactions were legitimate, right? Wrong. Wirecard was effectively selling payment processing services to itself by creating its own fictitious merchants to purchase payment processing services from its partners that were owned by Wirecard. Wirecard's second accounting fraud involved the use of opaque acquisitions. Wirecard would acquire smaller companies for significantly more than their market value, to add revenue from external sources and to inflate intangible assets on its balance sheet by up to $670 million from goodwill on consolidation. Wirecard's third accounting fraud involved the use of fake escrow accounts. Wirecard claimed that the huge difference between revenue reported from fictitious merchants and cash received from fictitious merchants was due to the fact that $1.9 billion worth of cash was held in escrow accounts. This justified Wirecard's cash shortages because an unnamed trustee would hold on to the cash until all stringent conditions had been fulfilled, enabling Wirecard to recognise revenue from delivering goods and services without receiving the cash. Following audits from EY, KPMG and the FT, it was Wirecard's failure to verify these escrow accounts that ultimately caused its share price to collapse, highlighting the impact of unethical accounting practices.
The fourth accounting scandal method that Wirecard used was round tripping, which they used to make their Asian operations appear bigger than they actually were by inflating profits. Essentially what Wirecard would do was Wirecard Germany would transfer cash to Wirecard Hong Kong in exchange for unused assets. Wirecard Hong Kong would then swap this cash for some other unused assets with an external customer that was under indirect control of Wirecard. The external customer would then use this cash to pay for payment services provided by some of Wirecard's Indian subsidiaries, and this would be recorded as revenue in the books of the Indian subsidiaries. Now this is unethical and it undermines the revenue recognition principle, as Wirecard's parent company has just transferred cash to its subsidiary, but it has still been recorded as revenue. This moves us on to the next part of the presentation, which will talk about the ethical implications. Quite a few accounting principles were violated. As mentioned before, revenue recognition was undermined, but also principles of consolidated accounting were not properly followed. For example, quite a few of Wirecard's international partners, their assets and liabilities were included within the balance sheet of Wirecard, which is not ethical because Wirecard did not have full control and direct control over these partners. The statements were complicated and were prepared in such a manner so as to ensure that investors found it difficult to compare Wirecard with peers in their industry. There were also various ethical implications. Wirecard misled auditors, financial institutions and retail investors, as well as their employees. EY, on the other hand, did not fulfill their ethical duty and were negligent. For example, the $1.9 billion held in escrow accounts could have easily been checked, but they instead relied on forged documents provided by Wirecard.
I'm going to talk about the lessons we learned from the scandal. So the scandal highlights that at least 4 lines of defense were surpassed. The 4 lines were the internal audit systems, the supervisory board, the financial regulatory board, BaFin, and the external auditor, EY, who all failed to thoroughly regulate Wirecard's accounts. This shows the need for more stringent regulations in order to prevent ethical disasters like this happening in the future. In summary, robust audit systems are crucial to uphold ethical standards to prevent misinformation being spread to auditors and investors.